This is what everyone should be doing with their money.
The model that I'll show you in a moment proves that whole life insurance is the most powerful tool, but it was not to be presented as the engine that ran the model. It was the turbo booster of all the other assets.
I want to go back to the basics, and I want to go deep when it comes to how life insurance fits into overarching planning and how it betters people's lives.
It's not about life insurance. It's about the model and the improvement of the whole. I have 2 machines now working instead of 1. I now have the death benefit, and we're going to say it's $400,000. Cash value, $291,000 at 4%. $100,000 still in the bank.
I've never actually thought about taking dividends from insurance. This scenario is going to blow the other scenario out of the water in every factor.
Are you in this game for the long term or the next 2 or 3 years?
Let me think. Trent Fortner, welcome to the BetterWealth show.
Thank you.
It's I don't even know how to introduce you. You've spoken at 3 of my events. You've been the mentor to so many people that are complete legends in the space. You've done a phenomenal job raising your family. Brock Fortner, who's been on the show, who's a friend of mine, is doing amazing work. You've coached hundreds, if not thousands of people in the space. You've been in the business almost 40 plus years.
Almost 40, yeah.
That's amazing. I'm better because of you and your teachings. If for those of you that are listening, you're not able to see that Trent's in person with me. He has his computer, which he's going to be sharing some things on his computer. We have this dinosaur looking thing that's going to be showing your ability to draw on good old fashioned paper. And we are in for a treat because what I asked you is I want to go back to the basics, and I want to go deep when it comes to all the ins and outs of how we think about not just life insurance, but how life insurance fits into overarching planning and how it betters people's lives. And so with that, before we jump in, thank you. And why don't you just give a little bit of just overview of like how you stumbled into this space and like what we can expect today.
I'll shorten the story a lot. As you said, it's almost 40 years ago, but I was stumbling in the insurance business when I first got started, just almost failing actually. And I was introduced to a process. Actually, I was introduced to 2 processes at the same time. I was introduced to infinite banking with Nelson Nash, which we did a lot of work together, which was a lot of fun learning with him. And then Bob Castellon with the LEAP system. And for me, I had an accounting background. So when I saw how the LEAP process worked, it resonated with me quickly. So I dove all in, and I became a 30-year overnight success. And but I put hours and hours and hours, thousands of hours into studying and practicing and using this with clients and coaching advisors. I was one of their national trainers for 10 years, I think. And that's where I made most of my friends that you alluded to earlier, that we all grew up in that training facility together, I would say. And it's been great relationships in this industry because of it. I would be the example for the value of relationship capital.
Yeah. And the power of, a lot of times people want to be more confident in this space, but competency creates confidence. And a great example of that is that when you didn't come with a script today. I didn't come with recorded questions to like, you can pretty much, I can ask you anything and you can pivot because you actually know what you're talking about. It's not just something that you're memorizing.
Not memorizing anything, but we'll see.
We'll see if I can talk to you. Before we jump into LEAP, because that's what we're going to spend a lot of time on, talk to me about infinite banking, your time with Nelson. Tell me a little bit about that, because you're not too many people can say they actually worked with Nelson, and like you were, it tells me that you're a little bit old too, but like when did Nelson come on the scene? This is 19.
This would have been, when I met him was 93, 94.
Okay. Before I was born. So
how about that?
Before I was born, you met Nelson. He didn't come out with the book yet. He was probably doing seminars.
He was doing it then. He was doing seminars. He had soon released his book right in those years. We did lots of seminars. We'd have 100, 200 people come to a seminar. In fact, Carlos Lara, who's the current president, was working in my office with me. I'm the one that introduced him to Nelson. He's taken it from there.
What was when you first met Nelson, what was your thoughts? And then like, talk to me about what it was like back in the 1990s, and what would Nelson be saying if he saw what a lot of people are saying with infinite banking now? Like, what are the biggest differences of what you learned back then versus now. I mean, I'm sure dividend, like the landscape of whole life is a little bit different back then than it is now.
Policies are a little different. Marketing is a lot different.
Yeah.
We have the internet today. We didn't have the internet then. We were just getting AOL with the landline. I can hear that noise of how you get on the line. But we spent a lot of time in conversation with families, and we didn't have a lot of software use at that time. We had life insurance illustrations, but we didn't have all the other softwares that we have today. He was fantastic at telling stories, and he spoke a lot to being very basic and fundamental in your explanation, because one of the best sayings I felt that I took out of it was, when you know what's going on, you'll know what to do. And when you understood the truth of the mechanics of how the policies worked, then you understood how strong the fundamentals and the basis of the policy was that made it so powerful into the future. It takes a little time to get those started. You always say at the beginning, it was like a water pump. You had to prime the pump for a while before there would be enough juice to flow out, enough water to flow out. And the capitalizing your bank period was real important. It taught discipline as much as it did knowing that you're building something into the future. The speed at which people are trying to make that policy work today is a lot different than what it was back then. The model that I'll show you in a moment, by chance, proves that whole life insurance is the most powerful tool in the model, but it was not to be presented as the engine that ran the model. It was the turbo booster of all the other assets. It made everything else perform better throughout its life. And so not by design, but by discovery, permanent life insurance becomes one of the most powerful tools in somebody's financial life.
That difference that you just illustrated and shared is what I think gets a lot of people in trouble. At the time of this recording, there's a big lawsuit happening, very public, and it's all about the product, how it was designed, the misrepresentations, potentially the negligence of it designing it, but it was all built around that thing. It wasn't incorporating how insurance could help the overall picture. It was like the Lone Ranger kind of deal. Whereas you're saying, even when you first learned about this, the goal was never to say, this is the end all be all, but this is how, when incorporated and integrated, can help everything else get better.
Yeah, that's exactly right. And you gave me a flashback here. I was speaking in Dallas about 10 years ago, and Wade Pfau was speaking there as well. Dr. Wade Pfau was speaking there as well. And he had just gone through an illustration about wealth building cornerstones, how that helped develop some of his theory around the strength of fixed products, non-correlated assets, to help enhance the 4% rule. So when he got through speaking, I was in the audience, and I said, Dr. Pfau, I got to ask you a question. After writing your book, and now you're saying there are great non-correlated assets that were insurance related. He mentioned three specifically. One was not insurance. It was permanent life insurance. And he said whole life insurance, annuities, and equity in your home for the potential of a reverse mortgage or something like that, so that you could have a buffer period for down markets where you didn't have to withdraw from your portfolio. I said, well, what's the advantage that you learned that you're teaching? He said, without a doubt, people who have permanent insurance, who have those fixed non-correlated products as access, will have more freedom, more options, more liquidity, and more income during their retirement years. So that's another actuarial academic resource that proves that this works. You mentioned the lawsuit. That lawsuit is around index universal life insurance. And you mentioned Infinite Banking when we first started, which is, they just put out a letter today in their email about going back and proving that the fundamentals, the basics, the strength of permanent whole life insurance, not all of the different risks that are associated in IUL, is what works in the banking process. IUL in itself is somewhat of a dangerous tool when it's not appropriately aligned in someone's life. And I didn't say properly structured. I don't know how to structure properly an IUL because there are more risks. There's there is some market risk. You can say that you'll never lose your principal. That's not true. If you have 2 down years in a row, then the cost of the charges and mortality costs and those things, they will draw down principal. However, unfortunately, the agent becomes a risk because for these things to last for a lifetime, the way they're designed, the way they were originally designed, you have to be able to manage the indexes. And I haven't seen anyone yet that's been trained well enough to do that, nor have those policies been around long enough to be able to do what they're illustrating. That's made up. It hadn't happened yet.
There's a lot of moving levers in the product, in the company, and then also in the agent. And a lot of agents aren't even making it. Like there's one thing if it's being sold in like a family office concept, you have a lot of eyeballs, it still can get messed up. We've seen it still get messed up at that level. But then you go to the person that's putting in a few $100, few $1,000s, it just these small policies, they got it through an agent that statistically is going to be out in a year. And it's just, it's a disaster waiting to happen. And what well said and what we're going to go through, again, I feel like IUL is an epitome of like, you're trying to replace other things. You're trying to sell it as a replacement. Even if you look at the lawsuit, is being sold as like a guaranteed lifetime income, blah, 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 blah. They're even using words that you can use in life insurance in some aspects. They're using it totally wrong, misrepresenting it. And almost they're saying this is the thing. It's going back to the Lone Ranger concept. So yeah, any predictions on what we're going to see? Like, I feel like it's going to affect everybody.
Yeah, unfortunately, it's going to put a black on the whole industry again. Those things come and go. What will stand out are that there's people still live until they don't. And there's a real need for life insurance. And if you're trying to buy life insurance primarily to get wealthy, it's not the right tool. But it is a tool to make everything work better. You could get to wealth by having life insurance. You could put families, future generations in wealthy positions. I know you and I both are friends with Garrett Gunderson, and I've spent a lot of time with Garrett over the years. And when he first got started, I was his mentor then. And we talk a lot about how everyone does have the opportunity to be Rockefeller-ish if you do proper total planning. It's not about a single product. It's about making all the products work together better.
Yeah. And I'm excited to dive into that. I will say, I just want to, again, I'm so grateful that you're here. And we have Truth Concepts, Circle of Wealth, Wealth Building Cornerstones have all helped me in my development. Mm-hmm. And they all stem from Leap in some capacity. They've all been influenced by Bob and what he's built through Leap. And so really what we're doing is we get the honor of learning from someone who's one of their top trainers who still to this day trains people on this. How many people have you coached throughout your lifetime? Because you have a coaching program that you help people, financial professionals in this space.
That's a tough question. I've been coaching advisors specifically for the last 18 years in January. And I've had 2,400 come through my own training. But then before that, for 10 years, as I was producing as well, 20 years as I was producing as well, I spoke in front of thousands of people that we trained to this. But Bob created the process. I learned it. He asked me to help. I was glad to help because it made a career for me.
All right. With that, let's dive in, and I will try to keep my questions to a minimum, but I can't help myself, and I'm excited. I'm excited to learn.
Let me butt in for something. You mentioned 3 great systems. All those systems. I'm not here to sell systems, right? I also have been trained in all of those systems. I have all of those on my software here, and they all are phenomenal at what they do. If you are an advisor who's out there, who's looking, how do I get better? I would say study all of them, but pick one that you're going to use.
Well said. Agreed.
How would you like to begin?
You tell me how would you walk through if someone's for the first time wanting to understand the why behind something, and then actually how you use this to talk about someone's whole financial life. And I would imagine the end goal is to make their life better in some capacity.
Yeah, here's what I tell all the advisors that our role is with this process. It's one thing. It is to help that person on the other end of the table that we're working with, not against, that we're working with, to have a better life than they did before we got here. Right. That's it. However we can do that. There's lots of things that will develop here in front of us in a moment on how we do that. The model itself is not to sell any individual product. It is to find the ways, the strategies to give them more of what they want and less of what they don't. Now, that's my words, but I'll prove why that's true in a moment. I want to go back and forth between, I'm going to do the overhead, old school style drawing. I'm more comfortable and faster with that. And I think if it's easy for me to describe and talk to you at the same time. I also have the software here. We're going to do some calculators, go back and forth. If we can, I want to go to the screen that is going to show what is called the present plan model. This is a LEAP model present plan. This is a sample case. This is not, it may be a live case. I don't know. We made this up. The names that are on here are not the people that we're meeting with. But let me tell you what this does. This, you may have heard, and you hear this in the LEAP community a lot because they talk about what's called the junk drawer method of financial planning. What that means is throughout our lifetime, we've gathered all this information. We've gone through different phases of our life. We've bought different things from different people at different times for different purposes. What the model is fantastic at initially, what its first step is to help you organize all of those items that we have acquired and put them in an organized manner on this model. And it's got two verticals in the model. The left side of the model is going to tell us a story about the family, their ages, number of kids, their ages, the income that they make, how much of their income is saved into their model. I keep saying the word model. Model stands, it's PSNG model. That stands for protection, savings, and growth. Those are all copyrighted terms of the LEAP system, which is now owned by an insurance company. Penn Mutual has been for almost 10 years, I think, maybe longer than that. It also on the left side of the vertical is going to tell us about the debt, how it's all their debts that they avail us to. It's going to tell us what they owe, the terms of that, the number of months remaining, how they pay it. And we'll have all those all those pieces on here. It'll also, if we have any additional notes, like are they receiving a bonus, a tax refund, inheritance, if that's coming in, we'd want to put that in there in the notes. The right side of the model is broken into the three components. I call them boxes or drawers. To me, it looks like a filing cabinet. So let's call them drawers today. Is that good with you?
Yep.
Okay, so in the top 9 drawers of this filing cabinet is the protection component. And for this model, I'm just showing that there's flows that are going in that are premiums in the protection areas. And inside the boxes are what the coverages are. Mm. In the next 9 drawers are savings, and we're showing what are their deposits and what are their interest rates inside and balances inside and rates of return that they're receiving inside of each of those areas. And the savings components, it's like first gear, second gear, third gear. As you move down the model, you wouldn't drive your car your whole life in first gear, right? So same thing here. As you move down the model, you forfeit a little liquidity, you look for some more tax benefit, right? As you do that, you might take on more risk because now people who are investing in Roths and 529s and 401ks or even variable annuities are going to take risk in the investments that are housed under the rule of IRAs, 401ks, those type things. Then as we move a little further, we're into the growth component. The growth component is bonds on the first level. So that's all about income, different kinds of bonds. The next one is going to be preferred stock, blue chip stocks, and growth stock mutual funds. So you're going to be talking about appreciating assets. Some of them will create taxes as you go because you'll have either dividends or interest, maybe some capital gains through turnover of the portfolio. Some won't create any tax until you sell shares. And then the bottom row, again, forfeiting some liquidity. You're going to have collectibles, real estate, and even business ownership. So bottom, anything that's moving from the left of the model into those boxes are inflows. Anything coming from the boxes back to the left in green are going to be cash flows to the consumer. Okay. Everyone has a present plan. Here's what that means to me. I meet you today for the first time. You put all of your financial information. That is the summation, the summary of all the best thinking you've had with all your other advisors the moment that I see you, right? So Caleb, if we're looking at your financial life, if we discover together that there are areas of loss that are going to happen in your life, It could be losses to taxes. It could be losses to fees. It could be losses to interest to other institutions. It could be loss of control or liquidity. It could be a big gap in risk in the protection components. If we were to find those things, what do you want me to do about it?
I would want you to tell me. I would want to at least know about it.
You would want to know about it. And then if I tell you about it and you agree that they are a problem, then what would you want me to do about it?
Help me figure out the best way to solve it.
Okay, so here's a question. If we discovered that those things are true and you want me to help you do that, and the summation says that the losses that are in place are because either your other advisors didn't tell you, either because they didn't know, they weren't trained to see it, or they were too busy and didn't care enough about you to tell you, would there be a reason for you to go back to them for information to move forward?
It's a great question. No. I mean, if you're able to show me something that the person I worked with before didn't show me, then going back to that person wouldn't necessarily make a ton of sense.
I don't think so yet. So, but I don't have to tell anyone in this process that the people that they were working with before did something wrong. They're probably doing the absolute best that they knew how to do.
Yeah.
Right. But it uncovers things. I use this when I'm talking to physicians like it's an MRI or an X-ray. Why does a doctor use an X-ray?
Yeah, because you get to show them exactly what's going on, and it's not your opinion. It's actually something that has greater authority that says, this is what your back looks like. How do you want me to go about this?
That's correct. So you're going to see things deeper that you could see maybe with financial statements.
Yeah.
Or we'll call it your naked eye. You're going to dive in deeper to see if there is a problem. And if there's a problem, now you have a choice. Here are the 3 choices before we go into anything else for the rest of this day. 3 choices.
Yeah.
Choice number 1, ignore the information. Do nothing. And there's a cost to ignoring the information and doing nothing.
Yep.
Now, you can ignore information and warnings, but you cannot ignore the consequences of what happens next.
Totally right.
The next thing you could do is you could treat the symptom. You could treat the pain, right? You could mask the pain. You could defer the pain. You could put the pain off. Or you could treat the problem and cure it. Now, those are the options that every client should have available to them if an advisor is walking through full transparency and disclosure of what those options are. Mm-hmm. My job is not to come sell you a product. In fact, I personally don't sell products. I'm not a licensed agent. I don't sell anything except the information and the coaching services to advisors and their clients. But when you see that there's a problem, and now you know there are 3 options, if you have a problem, is that something you want to hang on to for a while, or would you like to correct that right away?
I would want to correct that right away.
Now, if that problem could be solved without you adding more risk, would that be an advantage?
Yes.
If it could be solved without you having to come out of your pocket for additional expense, would that be an advantage?
Yes. That's kind of what I was thinking is like, when you say, would I want to solve a problem? Yes, but part of me, it would depend on the cost of solving that problem. Okay. So if you can solve that problem without it costing me a lot, it's a no-brainer. Okay. If it costs me a lot, then you have to sell me on why the solution of the problem is greater than the cost.
Okay, so this is easy. Easy explanation. Thank you for saying it that way. So I'm going to do a drawing here on another sheet. I put this page up here just to show all the numbers in it. So let's talk about what cost is. So today, this is where I'm going to draw. I'm going to do my financial physics, if you will.
I love it.
Today, we have people who are depositing money into their entire model. They're making premium payments into all of their insurance products to protect them when things go wrong.
Right.
And you buy auto insurance for what reason?
Or if something happens to my car while I'm driving or someone hits me, that I'm protected.
Yeah. So and it's really, it protects the bank. If you have a loan against the car, if you paid cash or if you finance it yourself, it will indemnify you for the loss. It will also protect you liability-wise if you hurt someone else. It will also pay you if you have uninsured motorists and they don't have coverage. So there's a lot of things that each one does, right? So we have dollars coming in all these areas. Well, we got to figure out if I'm doing what I'm doing today. Let's say we look at everything you're doing: protection, savings, debt payments, and retirement planning, college education planning, extra mortgage payments, paying your mortgage payments down, investing outside of a qualified plan. Let's say that number that's going in $70,000. I made that note. Okay. Let's say it's $70,000 a year. So I'm going to put 70K right here. That's coming into the whole model. Mm-hmm. If in our discovery, as we go through the protection component and you have dollars already saved and you're adding more dollars to it and you're doing what's called compounding. Compounding means that you earn an interest rate, that dollar's put back into that same account. So next year I have more money than I had the year before, right? Well, if it's a taxable account and you're taxed as you go, then you're going to pay a tax each year based on the amount of income you have. Well, if you're compounding your earnings, then you are also compounding your tax. Your tax is going up. Let's just say this was a 5% interest rate. If you're putting all that money back in here, then your tax rate did not change.
Yeah, but the tax that you're paying each year is higher.
That's right. The amount of tax.
The amount, yes.
Same 5%. They're equal. If it was in these top 6 drawers of mutual funds, if you're compounding, reinvesting, same thing would occur. It might have different type of tax rates because there would now be an ordinary income rate, a dividend rate, a long-term capital gain rate. And those could be as high as 40%, as low as 0%. You know, it could be 15 or 20% on cap gain type rates. So as we're looking at this, we would want to know where is the best position for our dollars, right? Well, if I know I am compounding taxes, that they're all going up, if my question to you is, if we could keep the money where it's at, basics of it, but we could do something about the earnings to where you could lessen your tax and have an equal or greater amount of cash and pick up benefits along the way. Can you think of some reason why we shouldn't do that?
Let me think, Trent. So you're essentially saying if you could lower my tax burden and give me more money along the way, I can't think of a reason why I would say no to that. Has anyone come up with something clever? You're like, I haven't heard that before. That's good.
I've had people say I haven't heard that before. Okay. I'm just glad I got it here in time.
Okay, great. Yeah. So you're essentially, you're not creating any pain for me right now. You're just showing me a better way.
Well, it might hurt if you didn't know about it before.
Correct. Yeah. Okay. Yeah. So if I spend my whole life doing something incorrectly, I potentially could have, lost hundreds of thousands, if not millions of dollars, depending on how we measure that. That could be painful.
Could be.
But future-wise, you're not creating any, I'm not creating any pain right now being like, okay, you're trying to suck money from me.
No, I'm helping you discover where money is being sucked from.
Okay. I love it.
So if we could cause it to suck less, would that be good?
That's a tagline right there. Yes, I'm with you. I'm tracking.
Okay. So we're not coming to any solutions yet.
Yep.
We're identifying problems.
Yep.
So in my process, when I teach people to do this, what we want to do is build an action now list. And that action now is, what are the things, Mr. and Ms. Prospect, that we discover that you would like to improve? So if there are areas of risk that you have assumed that you don't really want to, you could transfer someplace else. Would you want to do that? If you could do it with no additional expense, should we investigate how? The answers are yes. Now we have something that we should have action now on. Do you have the deposits that you're making to retirement plans or vacation plans or all these other things? Will they continue if you get disabled or not? If the answer is no, if you could add the words to make it happen, is there some reason why you shouldn't do that?
Here you go.
Okay, so we're going to build a list of all the things that are exposed per client for them. So it's different for every person.
Yeah.
It's all based on where they put everything. Another great question we have, and this brings up both the protection of income for disability and for life, is, Caleb, if you were disabled and no longer here to work ever again, I mean, you're here, but can't work again, how much of your current income would you want replaced and for how long?
As much of my income as possible for as long as possible.
Did I send you a script to say that?
No.
So I'm going to tell you, in the 36 years, since 1993, however long that is to today, 31 years?
Yeah.
That's how long I've been using this system.
Yeah.
100% of the time I ask that question, I get that answer.
Okay. I was like, oh, no. I love it. Yeah. It's logical.
Yeah. Did you know that if you pass away, you lose exactly the same amount of income?
Say that again.
Did you know that if you pass away that you will lose exactly the same amount of income as you would if you're disabled and never working again?
Yes.
So if you would like to add the words to continue to get as much as you could get for as long as you could get it, is there some reason that you would want to have a lesser amount of life insurance protection for your family than you would disability income protection?
No.
Well, everybody says that too, but you know what? When I show up to see people, that's one of the biggest gaps I ever see in all of their risks.
Is they don't have DI.
They don't have DI and they don't have life insurance equivalent to their economic life value. If you could get it and it didn't cost you any more, how fast would you move?
That fast and fast. And the pushback I would have is, we'll just take DI for example. It's something really, really important, but it is an expense potentially. It costs money, and so that would be maybe one of the reasons why people don't have it. But yeah, if you can tell me a way to check the box and it doesn't cost me anything more, of course, that's a no-brainer.
So we'll go back to the $70,000 going into your model. If we use exactly the same $70,000 that's going in to create more, is there a cost?
No, you're saying if we're giving you better results with the same amount of inflows that you're already doing, why wouldn't you do that?
That's right.
Yeah, I'm with you.
That's right. So they eliminate the cost.
Yes.
There's another thing that we do is we can reduce these other expenses to taxes, fees. Here come, I'm going to use a new sheet. Look, I'm just going to throw this in the floor.
There we go.
All right. So we got money coming in. We're going to look at savings first, and then I'll come to use a calculator in a moment. Let's just plain old say everybody's going to have some form of emergency opportunity fund, right?
Yep.
And they're probably going to have that their entire life. Would you agree?
Yeah. Explain the emergency opportunity.
Some people would like to save 3 to 6 months of their living expenses, maybe up to a year of their living expenses, to know that they have liquidity if something bad happens, or if something great happens, they want to take fast advantage of it. Liquid, accessible, you can move quickly. Does that make sense?
Yeah.
Okay. So let's just say that you had $100,000 total, money markets, checking, savings, whatever, and you're earning 5%. We're going to use a calculator here in just a second. Okay. And today you're 35 years old, and we're just going to take it to 65. By the way, how long do you manage money?
To the day you don't.
That's right.
I'm trying to channel one of the things you got to know about Trent's, he's got so many good questions. And so I'm like, what would Trent say? You live until you don't.
That's right.
It's like your go-to line. So you manage money until you don't.
That's right. Till the end of your days. And some people can manage it beyond that if they do this right.
That's right. I like that. Yeah.
So that's the Rockefeller method there. It's lots of methods that could make that happen. That insurance is a part of that, and inheritance and wills and trusts are all part of that. But if I'm going to measure the 100,000 and its growth at 5% from now until age 65, I would need a calculator. Mm-hmm. Let's say you don't put any new money in it. You felt like that was your year's worth of income. Okay. And year's worth of expenses. Mm-hmm. Okay. And that's for emergency and opportunity. So I'm now going to go to my calculator and I'm going to use my future value calculator. And we have the $100,000. Yep. In the calculator, one time, no ongoing payments. We're going to use a 5% interest rate. And we did that for how many years? 30?
30 years.
30 years. So this says that would grow to $432,194. 30 years from now. Caleb, what could keep that from happening?
What could keep that from happening if I take that money, what could keep that from happening is if I spent the money, if I got less interest.
Spend it. Less interest.
Taxes would erode that number pretty quickly.
It depends.
Okay.
It could. There will be taxes that are created, but do they come from that account?
That's true. Yeah, true.
So taxes, we could spend it. What else could cause that?
I could just lose. If the money is not safely invested, there could be dips.
This is safe. This is safe money, so it wouldn't be that.
I would say that would be, that would be my list.
I'm going to give you a few more to add to your list.
Perfect.
What if you got sued?
Yeah. If I got sued, that would be creditors could access that.
Yep. Completely accessible depending on how it's titled and how you own it. What if you got disabled? You might have to use it as part of spending it. What if you had long-term care problem?
Yeah.
Could that be a problem?
Yes.
What if it wasn't properly titled? You mentioned that. So that it could also be accessed. What if you died and you didn't have economic life value?
Say that again. If I died, I didn't have economic life. So yeah, this would be tapped into.
It would be tapped in. It wouldn't get to 432.
For sure.
Never would get there. So is it wise for us to try to protect it from as many things as possible?
Yes.
You mentioned some other things. We thought about them. I saw it. Inflation.
Yep.
That would impact it.
Inflation wouldn't really impact the number, though. It would impact the spending
power.
Yeah.
Yeah. But it's a real impact when you go to use it.
Yeah, for sure.
There could be charges on it. Well, if you got 100,000, you really didn't do anything but leave it sitting there and you're not doing anything else, the bank may charge you fees for not using it. Does that make sense?
It makes a lot of sense.
Okay. So now I'm going to go back to the calculator. I'm going to go do a different calculator. I'm going to go to a calculator called the Real World of Compound Interest. I'm just going to show you the one that we were talking about.
I appreciate that exercise. That just shows, like, even in a savings account, imagining you could earn 5%. There's a lot of potential things that we don't even think about that could prohibit uninterrupted growth over 30 years in a simple account. There's a lot of things that could get in the way for us not to accomplish that.
A lot of things.
And a lot of people that are just doing future value calculations or understanding compounding aren't factoring any of those things in.
That's exactly right. So we're going to do this on the calculator first, and then we'll go back and compare and how we use the model. Okay. So calculator, back to the 100,000. I'm going to take you through a story of how this actually works. So you have 100,000 in the account. By the way, the rate of return doesn't matter. The tax rate doesn't matter. What matters is the concept of, is this true? Is this economically true?
Yes.
And if it is true, then the numbers are whatever the numbers are.
Yeah.
So many advisors get so wrapped up in the magic of the software and the magic of the numbers of all those systems. That's not the magic. The magic is the ability to communicate whether are you going from good to better to best, and are you protecting it from everything else? So if we had the 100,000 today and we put it in your favor, let's just say it was in this room, and this room is an institution like a bank.
Yep.
Okay. And we had 100,000 in here, doors closed. Throughout every month, they send us a thank you for loaning them the money for use. Because that's what we do when we get it to the bank. We loan them the money. We loan it when we buy stock to our equity in the companies being used to do more things, right? So we put it in there. They're going to pay you a thank you. In this example, we're using 5%. It might, just 3 years ago, the high yield savings account that was advertised 1.8%, and people were bragging about it. So that varies, right? So 5%. If I kept it in here for 1 year, what would be the amount of money I would have in this room at the end of 1 year?
105,000.
That's right. You're 100. They slide the 5 under here. You got a thin door there. They slide it in. They lock it up so it doesn't go back out, right? So under 5,000. Now, we said a moment ago that this could be taxable. So I'm going to use a 22% tax bracket.
And it would be taxable if it was a savings account.
That's correct. That's right. If it's in a non-qualified account, meaning it's not in a retirement plan or a Roth, it's going to be taxable, right? So if it were taxable and there's a 22% tax, the tax 22% on 5,000 is $1,100. Here's my next question. How much money is in this account at the beginning of year 2?
105,000 minus 1,100, which would be 1,390 bucks.
It's a great answer. And that's exactly the answer I got when I spoke to the Tennessee Society of CPAs almost 25 years ago. And that's not the correct answer.
Oh, no.
That would only be true if you're netting this particular account, because you don't pay your taxes from this account. You go to your checking account to pay the tax.
That's right.
We're in Tennessee. Yesterday was filing day because of all the floods and everything. We got extension to November 3rd. Most of the people that had to pay taxes did not go cash out their CDs and their money market accounts and their growth stock mutual funds. They went to their checking account.
Yes.
So if that's true and we are compounding uninterrupted, if I do this for the next 30, and by the way, that's the reality. If you go to the bank and say how many people are netting their accounts, it's less than 1%. In the whole world, not just here, happening. So let's go to.
But it is happening in their economic model.
In their entire model, yes.
Yes.
We have money leaving their model.
But it's not happening from that account. So a lot of times a lot of these things lack accountability because you don't actually see it. So that it doesn't create pain even though it's happening.
I'm holding up a pen.
Mm-hmm.
I dropped the pen. Why did it hit the table?
Gravity.
Gravity. Do you have to believe in gravity for it to work?
No.
Was it happening whether we saw it or not?
Yes.
Same thing here. Financial physics is like gravity. I'll walk you through this. So if we compounded our earnings at 5% for those 30 years, it grew to $432,194. It's right at the bottom of the screen, right here. So I'm going to put this on this other sheet. Started with 100. It grew to $432,194. But to get there, we had to put our own $100,000 in there to begin with, right?
Yes.
Another thing that happened is we had to pay taxes. And we paid taxes along the way every year.
Yes.
You see the schedule every year of the tax.
It's higher and higher and higher.
The rate did not.
Yes.
The amount we paid did.
Yes. Sir.
And it got how much greater? Well, this easiest way to find that is to go to year one. In year one, we paid $1,100 in taxes on $105,000, 5,000 inches. Year two, we paid $1,155, but that was on $5,250. You know what that rate of increase is?
No.
5%.
That's right. Okay.
5%.
Yes.
Because the savings account was growing at 5%. The taxes went up by 5%. It's an ignored cost that people, they just don't think that way.
Yes.
That's the compounding of taxes. So our taxes, total taxes that we actually wrote checks for, $73,083. Now, if you give Uncle Sam $1 in tax, what do they pay you back in interest?
I don't know if I don't know. 0.
Have they ever given you money back on tax you gave?
Well,
No?
is there something I don't know? Okay.
It's a valid question.
Yeah.
So would you consider taxes a loss?
Yeah, for sure.
And at least a 100% loss.
100%. Yes.
It's more than that. Now I'm going to show you the more than that. You've heard the term opportunity cost.
Yes.
So if I write checks to the government, do I get to save them in this account at 5%? Or do I get to save those dollars in my mutual fund? Or do I get to use that to pay down my debt?
No.
So I lost that at whatever my highest opportunity cost of money rate is.
Correct.
And here's how you determine cost of money.
Highest. Wouldn't you say couldn't you also say lowest as well? Your lowest.
If you found $1, would you put your dollar in your highest fund or your lowest?
I mean, I would put it in my highest, but that's what I'm telling you. I don't know if that's actually what I'm going to do in real life, but I hear what you're saying.
All right, here's another way of saying that. Which would be riskier? Paying the government $73,000 in taxes, or taking that same $73,000 you were going to lose at 100% and go to Vegas and gamble for a weekend? Which is riskier?
The government.
It is.
It's guaranteed that you're going to lose.
Yeah, at least you have some fun at Vegas for a while.
Yes.
Even if you lost all of it.
Yeah. Yeah. So paying taxes is a complete loss.
Okay. And here's how much more of a loss it is. So let's use the 5% rate. Here's how we could determine what cost of rates are. If they didn't have any other savings or investments, we would use
the 5%.
And the net of 5%. So it would be, this was 22%. So it would be 78% of 5 would be our net rate.
Okay.
Okay. Which is 4.35.
Okay.
Okay. But we're just going to use 5. If they didn't have any other savings, but they had a lot of debt and they're paying 20% interest, well, they had to go use debt to live. It cost them 20%.
Oh, yeah. Totally.
Because they couldn't pay it down.
Yeah.
If they had a 8% mutual fund, they could have lost the opportunity for those taxes at 8%. We're going to use 5.
Yep.
The concept, remember the concept. If the concept is true, the numbers are relevant. So if I wrote checks for $73,000 to pay those taxes, that cost me additional wealth of $62,750. That's opportunity cost. That means that because I did not save it, I do not have $63,000 I could have had I been able to save it. If there's a way to reduce those costs, keep the money of $100,000 at the bank for whatever reason you like having it at the bank, and to give you at least the same amount of cash and maybe more benefits, would you like to know how to do it?
Yesterday. Yes.
Yesterday. Okay, so we're going to do something. We're going to test this. This is compounding. I'm going to write it here. Compounding taxes and return. So same 100,000.
Yeah.
Same bank, same 5%, same 30 years. Only this time when we earn the 5%, instead of sending the interest back into the same account like we did in compounding, we're going to do something called, I'm going to do this in green. Green is good, red is bad.
Yeah. I can get behind that.
We're going to do something called flatten the taxes. So what we're going to do is we're going to send to you $5,000 of interest every single year for 30 years. Is it still going to be taxed?
Yes.
But it's not growing.
Yes.
It's going to be $1,100 every year for 30 years, 22% on 5,000. Assuming the tax rates didn't change, assuming the interest rates didn't change. Testing the concept. So if that's true, we'll first talk about how much money will I have. So I'm going to go to click a few buttons here, and I'm going to go to interest only. Now what it's showing in this is the $5,000 to you every single year. So how much money do I have in year one at my bank?
100,000.
How much do I have in year 30 in my bank?
100,000.
That's right. It didn't grow in the bank.
Yes.
Now I might have been stuffing 5,000 in my mattress for 30 years.
Yes.
But we're probably not going to do that either.
Yes.
Right. I still have to pay taxes.
Yeah.
But now, because I flattened it, my taxes are $33,000. That's what I'm actually paying in taxes. Remember what I paid originally?
62.
That was my opportunity cost.
Oh, 70. Was it 73,000?
Yep, 73,000. So what just happened?
You eliminated over almost $40,000 worth of taxes. That was like a complete loss.
Yeah. So where is it now?
That's a great question.
It's at least in my hands, because I was going to have to send it from my checking account to the government. And now I don't have to. And if I don't have to, it should at least be in my checking account.
Yes. Can I? So we do, what's the difference between 5,000 minus, so it's 4,900 times 30. That's only 147,000 though.
Do that again.
So
tell me what you did.
So I took 4,000. Oh, I did that math wrong. 3,000. I need to do 3,900.
Why do you need to do that?
Multiplied by 30. Well, because you're saying you were paying less in taxes, but we're not earning. That money's got to go somewhere to earn.
Okay. So when I received the 5,000, did they take taxes out of it?
No.
So if I pay taxes exactly the same way I did before from my checking account.
Yeah. So then you have 5,000.
I have 5,000, and I paid $40,000 less over those 30 years because I did that.
Yes.
And if I paid $40,000 less, and that means I still have the $40,000 to do something with.
Correct. Yes.
So that's a plus on my side of the table.
Yes. Yeah. I'm sure you're going to get to it. It's on one side, the savings account is compounding at 5%, and the money that the $5,000 you're receiving, what are we doing with that?
Okay. That's part two.
Okay. Sorry. So yes, I'm so far we're paying $40,000 less in tax.
Okay. So if I now only pay $33,000 instead of $73,000, shouldn't my opportunity cost go down as well?
Correct. Yes.
Okay. So that means that I took the difference and I saved it at 5%, and that'll tell me what this number is. So the total taxes and opportunity costs are now $73,000 instead of
that added together. Yeah. Which is like 135.
That's right. But now it's 73. So that means the 62,750 is what my 40,000 grows to. Does that make sense?
No. Yeah.
If I took the same schedule I was going to pay in taxes over the 30 years originally.
Yes.
Instead of paying taxes with it, I took the difference, that 1,100 from 1,155 in year one, year two, and 1,100 to whatever the next one was higher the next year. And I save it at 5%. It would turn into 62,750.
Yes.
So that's a plus.
Yes.
You're doing something with your money. Okay. But now you say, well, what do I do with the 5,000?
Yes. Because you could put that in a savings account at 5%, and the same thing happens.
Same thing happens. So, but what if I put it in a tax exempt account?
Then you don't have to pay taxes on that.
Let me ask you a few more questions. If I could double the cash flow in the event you got disabled and not have to liquidate your $100,000, would that be an advantage?
100%.
If we could self-complete this, that it would grow to the 432,000 in 30 years if you died tomorrow, would that be a good thing?
Yes.
If we could protect more of it from creditors, would that be a good thing?
Yes.
If we could protect it from long-term care, so you don't have to spend $100,000, would that be a good thing?
Yes.
If you can have access to the growth as it goes to create other assets, would that be a good thing?
Yes.
Without ever touching the 100,000.
Yes.
You're good on all those?
Yes.
Let's see if we can do that.
Okay.
So if I took the 5,000 and I moved that up to permanent life insurance, plain old boring whole life insurance. And I'm even going to say all base, no PUA. If I did that, that's going to buy some amount of life insurance.
Yeah.
This guy's 35 years old. You could probably have somebody run an illustration and tell me what that is. I don't know, but I bet it's more than $100,000.
Yes, for sure. Yeah.
And it's going to grow over that same time period to some bigger amount. We should probably run an illustration somewhere along here to get that. Then what's going to happen is we're going to get liability protection on the $5,000 that's growing. What do you tell people in your experience in illustrations is what does your $5,000 in a whole life policy usually grow at what rate?
Anywhere from 3.5 to 5.
Okay. So you want to use 4?
Let's use 4.
So I'm going to go to my trusty future value calculator.
I think 4 is a conservative number for 35-year-old over a long period of time, but
it would be whatever the illustration has, the way we build it. But we're going to use 4. We'll go in the middle. We'll go to 4%. We'll use the same future value calculator that we used earlier, but now it's on it. It is on annual payments of $5,000, not a $100,000 base amount. We're going to use, you said 4%. We'll do that for 30 years. And there's $291,000 in this account. We'll call that cash value. Mm-hmm. $291,000 here. How much is in our bank?
100.
100,000. How much more did we get by not paying taxes and investing at 5? 62,750. Yeah. What else do we have?
You have a death benefit.
We have a death benefit that's probably close to 400,000 by now. We'd have to run. I'm going to just say it's 400,000.
Yeah, I'm cool with that.
Okay. You also have, if you got disabled along the way, those deposits continued.
Yeah, because
by the insurance company through disability waiver premium.
Yeah, talk about that.
If you qualify for it with this is so powerful. You have to qualify with your health and your wealth.
Okay.
You can't just stroke a check for life insurance. So if you qualify for it, the insurance company has a contract that says, under the terms of disability waiver premium, if you are disabled for 6 months or longer, they will pay your premiums future until normal retirement age or age of the contract. And I've seen between age 60 and age 65. So if you're disabled before age 60, they'll pay all the premiums just as if you had. You have all the rights to the contract just as if you had. You pay nothing more for that except the disability waiver premium, a small premium. So if I got disabled, I would get to keep the interest from the bank. The insurance company pays the premium. Yep. About year 3 of every standard rated policy with every whole life company, year 3, year 4. Yep. You're going to have the cash value is going to grow
greater than what you put in
from that point forward for the rest of your life.
Yep.
Every year. If that's true, I could access, you know how to do that through leveraging your policy. I could access the growth every year.
Correct.
So now I could have 10,000 and the next year I might have 12,000, 5,000 of interest, 5,000 from my policy.
Yep.
Right. More access. All the cash values in the policy in most states, in almost all states, is going to be 100% protected from creditors and bankruptcy. In some states, it's less than 100%. Don't live in those states. And you can probably guess which states.
Yeah.
Okay. And we also have long-term care protection. And because this has a beneficiary designation, the death benefit bypasses probate. And it is a form of a trust in itself, depending on what the settlement options are. And if I get to age 65 now, I made it. I lived. I got there. If I had not paid for any other term insurance before, if I had paid for term insurance, I could recover that too. I could say term cost avoided. That'd be a plus, right? But I get there, and now I have this $400,000 death benefit, and I have this other $400,000 worth of cash. Do I have more than I would have had compounding?
Say that one more time. I just want to.
Originally, compounding,
yeah.
I had $432,000.
Yeah.
And I had to take out the taxes of 73.
Yeah.
And I lost another 62.
Mm-hmm.
So after I put my $100,000 in, there's another 135. I'm down to around 250.
Yes.
That's about right, right?
Yep.
Okay. Over here, same 100,000, but I flatten the taxes instead of compounded the taxes, and I put the money in motion without accessing cash value to build other assets. You know how to do that.
Yes.
We can do that, right?
Yep.
and the statement would still read the same on the life insurance ledger.
That's correct.
The bank statement still there, 100,000. I have 2 machines now working instead of 1. I now have the death benefit, and we're going to say it's 400,000. Cash value, 291,000 at 4%. 100,000 still in the bank.
So you already have more money. You already have more money than what you have, and we haven't even included taxes.
And include tax and opportunity of 62,000. And we have more spendability of our other assets after age 65, because now our death benefit gives us permission to spend down differently our other assets.
Yes, and you have better protection. Yes, I definitely want us to go down the permission to spend concept. But so this is you walk through this concept with people just to share the example of just how this model works.
One, to show how it's coordinated and integrated throughout. It's not a single product that you have to count on to get somewhere, which is what most people do. Trent, I'm earning 10% in my 401k. I'm maxing out my 401k. But you got all these other things going on. Your 24% credit card debt's going to wipe out.
That's true.
10% mutual fund, 20% mutual fund. The taxes that are going to be there later, the portion that you have to pay more to the government because you're in it, not less, more. The reason you pay more is because the government's portion is earning the same rate yours portion is. So there's lots of things here. The use of the model, though, is why I show this. And it also showed, my goodness, life insurance was a great tool there.
Yeah. You not only have more money, but you have better protection. And the only thing you give up is in the first couple of years, you may have less liquidity than the first person.
Disagree with that.
Okay,
I 100% disagree with that.
Most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built The Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock The Vault. All right, back to the video.
If you put money into a life insurance policy versus keep it into a high yield savings account, how do you have more liquidity or the same liquidity than the person that has their money in it?
I had 100,000 in there.
Yeah.
Is it still liquid?
Correct. Yes.
It is still liquid. If I was paying for term insurance and I don't have to now, where's that money?
It's redirected somewhere.
And if I'm lowering my taxes, I have more. Now, how much different? A little bit different. But if you're compounding in this one micro decision in the macro conversation, why would that even be relevant?
It shouldn't be. It shouldn't be. I think would you say if we map this out, probably in the first 1, 2, maybe 3 years, you may have less money, but over time, it's gonna this scenario is gonna blow the other scenario out of the water. In every factor.
Are you in this game for the long term or the next 2 or 3 years?
Let me think. Lifetime.
Yeah. So if we can create the momentum, the tortoise and the hare store.
Correct.
If we can create the momentum and take control of our money decisions, not just this one.
Yeah.
You wouldn't show this to somebody that doesn't have any money saved.
Yeah.
Right. We're not talking compounding taxes to somebody that's not compounding their earnings.
Yeah.
We would talk to them about the strategy that impacts their life to improve it. Whatever that strategy is, there's about 50 strategies, but you don't have to know all those strategies. Mm-hmm. What we do have to know is, how do we test the financial physics? And here's the story. So you really put this in place. If I look at your financial life, the first thing I want to do is find where are the risks that you have assumed that are not yet covered if something goes wrong.
Define risk.
If you had a loss due to a car accident, you could lose your income and you could lose your assets that are exposed if you don't have enough liability protection. So that's a risk. So if I could maybe raise the deductibles on my auto and homeowner and use that savings to buy more personal umbrella liability coverage, equivalent to what I qualify for, size of my estate and my income, would I be better protected?
Yes.
If that's all I was able to do for a client, it cost them no more money, but now they're better protected, was that a worthy conversation? Even if I don't sell property and casualty insurance.
Yeah.
If I went to their advisor and said, this is something you should talk to them about, I wouldn't say it that way. I'd say, Kevin, we have a mutual client. We discovered that your client needs more protection with you. They like you. This is what we discovered. Can you help them get that? That's what we would do. If they didn't want to do that, then we could help them find somebody else. But same thing on their protection of disability. If your income, let's say you're going to earn $100,000 a year with no increases for the next 30 years. So that's $3 million you would earn if you never had an increase. But if your disability plan only pays you 50% of your salary, you're going to get 50,000. You're only going to have $1.5 million. There's $1.5 million lost.
Yep.
If there's no raises, no bonuses.
Mm-hmm.
If we could do something to protect that, would you want to? Now, if you did get 50,000, you do have coverage. That's great. That's awesome.
Yep.
But what about the deposits to your retirement plan, deposits to college funding, the rental properties, the debt, the mortgage, all those things? Are those going to continue? Would you like for those to be continued? Would you like for your deposits to continue if you can't physically do that?
Yeah, absolutely.
Do you want to have to do it, or would you prefer someone else legally agree to do it for you?
Yeah, I mean, I would love to leverage proper strategies to do it for me if I can't.
So there's two ways to do that. It's a combination. One is insurance, and there's a limit on how much that will do.
Life insurance.
That's for disability insurance.
DI.
Yep. And then there's life insurance to protect you for if you're deceased. It's also passive income we could create. So if we create assets that create cash flow that pay you, that's a form of protection. Now you have choices on how you spend your time and how you work, how much time. And if you build like Justin Donald says, I know you've been a part of there, like Justin, good friend of mine, and what we're looking for there is to build a lifestyle where your assets are paying you. Eventually, it'd be great if your lifestyle and your assets are paying for all your life insurance, not your income that you have to go earn. That's the objective of the model. Now, how can I pay for disability? Well, if I couldn't get all my disability right now, what about in year 2 and year 3 when there's dividends? Could I use the dividends from my life insurance to pay for my disability insurance? Would that be effective?
I don't know. I feel like this is, yes, I'll say yes. I haven't I've never actually thought about taking dividends from an insurance, buying DI. But
if my dividends pay for any of the other insurance, or if my dividends pay down my debt, or if my dividends are there, an asset that I don't have to go work for that's coming in.
Yeah.
If I use that to pay for those things, don't I get to keep more of my earned income or have a better choice on where I put that earned income?
Correct. Yeah.
So it's not about life insurance. It's about the model and the improvement of the whole.
Yeah. I like this because you're talking protection, savings, growth, and you're looking at how each box works with all the other boxes. And going back to what you're saying, someone could say, yeah, I'm crushing it with crypto. It's like, okay, your whole model's a disaster though. You might be that one box might be glowing, but there's so many other boxes that are a train wreck. And so that's just an example of just like, and so many times people are not thinking, like even the people that call themselves planners are not doing planning. A lot of them are doing, stock picking, but it's rare to find something that's so interconnected. And yet this is what everyone should be doing with their money.
So you made a statement just before a little break that was, somebody might say, I'm killing it in crypto. Define what that means for me.
Over 100% growth year after year.
It's awesome. So have you accessed it to create usable dollars with it?
Most crypto people are, no.
Okay, so when you go to access it, there's going to be a cost to accessing that. It could be fees, transaction fees. That's part of it. It could be taxes. It could be a lot of taxes if you're crushing it. So my question would be not don't do crypto. The question is, if you're going to go from statement wealth, that could be your investment portfolio, that could be your crypto, to usable dollars, and you can compare those to contractual wealth and statement wealth, whether you get a better balance. You could free up, again, taxes. I'm always in the model in the lab. The lab is the worksheet. Then we put it back into the holistic present plan, the new present plan, to say, how did it impact the whole? So if the sum of the parts are moving forward, then the whole should be moving forward. If one area is going up, crypto going up in value, but you haven't accessed it, what value does it have? Does any dollar that you don't access have a value?
That's a good question. Any dollar that you haven't accessed
or can't
access, does it have value? I guess if you can lend against it, there's people that are rich on paper. They can go to a bank and
lend against it. But outside of that, no, you can't go to the grocery store and say, hey, you look at my portfolio, I'm good for this. They want real cash flow.
Yeah. Equity in your home. You can't go take some dirt and brick to the bank and say, hey, can I have $500 for this?
Mm-hmm.
It's there, but there's a cost to getting it. You might have to pay it.
Is that what you mean by statement wealth versus contract wealth?
Statement wealth looks good on paper. I'm about to go through a calculator with my versatile calculator to say how good does it really work and what is it really doing.
Mm-hmm.
Okay. And then let's just say I had a really big capital gain, crypto. Let's say you bought it for 100,000, it's worth $1 million.
Yeah.
And if you were going to sell it, man, I'll crush it. I'm going to take my $1 million and I sell it, and I'm going to have to pay a capital gain on $900,000. If I could get the income from the $1 million and not have to pay the tax, would that be better? If I could have access to the whole $1 million, not only not have to pay the tax, but I could free up another asset that hasn't yet been taxed to create income from, would that be even better?
Of course. Yeah, of course.
And then if I could use all that as income until the end of my days and then replace it when I'm gone, tax-free, would that be even better?
Yes.
That's what we do with the model. What does life insurance guarantee if it's in force? It guarantees the income of the future tomorrows.
Yes.
That you're no longer here to produce. It indemnifies the family for the income that's lost. It doesn't replace you.
Mm-hmm.
But it does keep them in an ambitious world.
Yeah.
That's not increasing your income over time.
Yeah.
It's not providing lump sums. It's providing the asset that would pay the income that you would have produced had you been here.
Yeah.
To just keep you in the life you're in, not to advance your life.
So a common talking point right now is buy term and invest the difference. And it's the buy term, invest the difference. Your nest egg is going to be far greater when you hit 60, 65, you drop the term, your nest egg grows, and they're like, this is the strategy that's way better. And if someone's talking to you about buying permanent life insurance, they're trying to rip you off, they're trying to scam you, they're trying to steal all your money. How would you approach if someone's like, Trent, I believe in buy term and invest the difference, and I believe this is the right strategy for me, but I'm open, because I know you're not going to spend any time trying to convince someone who doesn't care. But if you're like, show me why, a better way, especially if you can show me a better way using permanent life insurance, I'm very open.
Okay, there's two things I'm going to do. First, I'm going to draw my other one.
Yeah.
Okay, we might need to switch that other camera back to my. So we're going to put the $1,000 a year going into the term insurance.
Yep.
And it was $1 million policy. We'll change the ages just a little bit, keep the numbers the same though, 35, 65. And we're going to invest $12,000 into the 401k and maybe $10,000 into the non-qualified, same investment portfolio, growth stock mutual funds. I'll give them 10% rates of return.
Okay.
I really don't care what the rates of returns are. We could go back and do calculators, but first question is, what would cause this plan not to work? What's the one thing that would blow this up?
So you're putting $1,000 into term. You're putting $10,000 into what?
Growth stock mutual funds, 10%.
And then 10,000 into
401k here, 12,000, 10,000 in growth stock mutual.
Okay. What would cause this thing to blow up? The underlying investments could underperform.
Okay, one, less performance. Lower rates, right?
Yep.
Market volatility. Put market volatility. We just proved that, right?
Mm-hmm.
What else could make it not work?
I mean, I wouldn't say fee is our reason it wouldn't work, but it would damper things.
Fees reduce output. What else would keep it?
I mean, I look at this and say, man, I have no control over my money my lifetime.
No control. What else?
Just, I mean, that's my list right now.
A lot of this will not be liquid. So liquidity issues.
Yep.
What about disability?
Yeah. If I get disabled, my whole thing blows up. You're right. You're totally right.
That'd be awful, wouldn't it?
Yeah. If I get sued.
It's sued. The only thing here that you'd have protected would be your 401k, but this would be gone. And you might have to withdraw money from the 401k, and you can only withdraw it if you're no longer employed, or you borrow from it, not against it.
That's right.
But then you have to pay it back.
Mm-hmm.
If your income's garnished because of the lawsuit, you won't be able to put it back.
Yeah, you're just drowning. I mean, creditors come out, like if you get you said sued, if you get disabled, you could say that if you died, you have term insurance that cover you.
Yep.
So
that's good. If you die before age 65.
Yeah. If you die after age 65, you would have
The balances.
Yeah.
But they still be subject to taxes, and depends on who they're going to.
Yeah. Yeah.
Okay. Anything else? I'll put taxes.
No, I don't. Do you have anything else?
So to begin with, for this to work, everything has to go right.
It feels that way.
Every piece has to work the way you had planned. If any one of these came in and happened, this would be detrimental to your plan. That's the first thing. So what if, same dollars, what if one, we didn't do anything at all with 401k to start at first?
Yep.
Okay. Keep the $12,000 going to the 401k. $10,000 that was going to this portfolio, let's say we put it up into the permanent insurance.
So you have 11,000.
We'll take the $1,000 that was going to term insurance and put it down here because we weren't planning on getting that anyway.
Okay.
Okay. So the $10,000 coming up here on a 35-year-old, it might not buy $1 million in year one, but we could engineer the policy, right, to get it started $1 million. Or maybe it gets 700,000 and with dividend additions, it grows. Yeah. And you know how to do term riders and whatever the mix. Even without building PUAs, this would be a good thing. It will grow over time. Now, if we got disability waiver premium, does it continue?
Yes.
If they get sued, does it continue?
Yeah.
We didn't say this, but long-term care, critical illness, terminal illness, does it continue?
Yes.
Does the retirement plan continue? Probably not, but I got $10,000 a year that does.
Mm-hmm.
That's growing. If I still had a balance here in the old account, instead of putting it all there, maybe I had some in there, I could move earnings up to get to another 12,000, maybe, I don't know. Mm-hmm. Or I could delay my 401k contribution and put 22 up there. Now, what do I have? I have gained. These are gains. In fact, I'm going to change that to advantages. Here's the advantages. I had the risks of all those things that made it not work before. Mm-hmm. We'll call those risks. Big risks. I come over here and the gains are 1, control. I have gained control of my money, or most of it. 2, I have gained creditor protection, completion in the event of disability and death, access to capital that is liquid without liquidating the account, which means I could create more than one asset.
Right.
If it goes into the 401k, it's going to do one job only. It's going to go in, it's going to accumulate until you terminate, and then you'll distribute. And it only does one job at a time. Life insurance does multiple jobs at the same time.
That's right.
Whole life insurance does multiple jobs at the same time. It's the only one that does. Mm-hmm. We could have lessened our market volatility. We have already said creditor protection. We've lessened our taxes. And now we have a strategy in place that we might be able to do. Said earlier, what if we could do something where you don't have to tax on dollars have to taxed you? Well, what if we did have dollars in there that grew? What if we used the infinite banking process that you like and we borrowed against the policy and bought all that crypto? Now, I wouldn't do that. I personally wouldn't do that because I'm taking non-risk money and I put that at risk.
Yeah.
I wouldn't do that. I'd put my term insurance money in there.
Yeah.
I'd put my tax money in there, but not my
safe money.
Not at all. Guaranteed money. Tax exempt. But I would put others. If I did that though, that is big gain. Instead of selling those shares directly, I would retitle those shares into a charitable remainder trust that says, I'm going to leave at least 10% of the corpus of this trust, this big gain. Let's say it was $1 million. We said that a while ago. I bought it for $100,000. It grew to $1 million. And I'd have a $900,000 capital gain, right? If I sold it to you or the market. Well, now I'm going to gift this $1 million to the charitable remainder trust. And when I do that, I get a deduction on the fair market value of the gift. And it could be as high as 35 to 40% deduction. If I have a 401k that has grown in value, that's not been taxed, and I get a deduction for my gift, my charitable trust, wouldn't that be the right time to take a lump sum from my 401k to eliminate the taxes? Mm-hmm. Now, the problem with that is when I take this $1 million and I put it in the trust, it's out of my estate. So what do I need for my beneficiaries?
Something to cover that asset.
At least $1 million asset, life insurance, to come replace it. Now, the charity's going to pay me an income for life.
Yeah.
And the income from the trust is treated a lot like an annuity. So it's not all taxable. So I got a tax favored income. I pay less taxes. I have more income. I get to enjoy more money. I get to leave
You
more.
essentially can annuitize your money. But instead of selling, paying a ton of taxes and put it into an annuity, you can put that money into a charitable remainder trust, get a higher income. The only disadvantage is it's out of your estate, and strategies open up when you're able to have a permanent death benefit.
And it was the fact that it was there gave you.
Yeah. This is great.
One more thing.
Yes.
The buy term and invest. What we're doing here is we're gaining control. If you follow what you've been teaching on investment strategy, and if people are comfortable with the risk of, you can be a better investor if you're a better market timer. If you have non-correlated assets that you could borrow against to make the investment. Let's say I had $1 million in my portfolio and it dropped by 30% today. Well, for it to come back to where it was, I'm going to have multiple years of greater than 30% rates of return to get back to it. Right. But if I had, the loss was 300,000, million minus 30%. So if I took that 300,000 against my investment, against my life insurance, a loan against my policy, and I put it in the market, and it came up 10%, I got a return on that money. I'm not waiting for the whole 700 to come back.
That's the, if you did not leverage against your life insurance policy, if that was off the table, someone could play devil's advocate and say that by putting the life insurance, you're more protected, but you could be taking a pretty big bath on potential growth. Is that fair to say? Like, because a life insurance policy might be earning 3 to 5%.
Okay.
Versus, and I know we went through the calculator, but
we don't have to go through the calculator. I can answer the question.
Yeah.
So first of all, you're saying as an individual who bought the whole life insurance, you have the ability to take the access to the money off the table? The contract that they gave you, that gave you the privileges to use it, you as an owner are going to say, I'm going to take that off the table?
Well, I don't know if that's what I'm saying. I'm saying is if you didn't, when I'm saying yes, I'm saying if that was not, you were not able to take loans against your policy. Just hear me out here.
Okay.
You could say that the return of the person doing permanent life insurance could be significantly smaller than the buy term and invest the difference. You could say that. Now, I would say more things could go wrong in the person holding whole life insurance and they're way more better protected than over here. It very much feels like if one thing goes wrong, the whole thing gets blown up.
Okay.
But when you factor in the ability where you can actually borrow against that capital if you wanted, you almost eliminate that conversation altogether, because if someone, all they cared about was to get greater return, you're not saying no to that ability to do that. Is that, are you trying to, I don't know if I was really articulate with that.
There's two things I would say to what you said. Number one, you're going from, a lot of people say what you just said, but that's not reality. Once you buy the whole life contract, you have, by contract,
correct,
the ability to leverage it.
Right. But a lot of people that are anti-life insurance are not thinking about that. They're thinking about it as
they're wrong?
Yeah. They're thinking of it as a terrible place to put your money.
So they're wrong?
Yes.
Yes what?
Yeah. I mean, they're wrong.
They're wrong. So why does it matter that they say it?
Well, because that's when we're creating videos, is to help educate people, the talking points on.
So economically, are they wrong?
Yes.
Okay. So and I'm going to tell you cannot outperform with a single investment by itself, because that investment is going to do one thing. It is going to accumulate while it's accumulating, and it will distribute when it's done. And that's the only thing it will do. And in the meantime, you just have to wait and see, hope you get there. If I had cash value, when I have cash value, I have cash value. I have a lot of cash value. When you have cash value and you have the ability to borrow against it to make the investment, let's say the first option is I have 100,000, 10,000, $1 million. It doesn't matter what the number is. I have 100,000 in a savings account, and and I'm earning 5. But somebody said, Trent, you can earn 20 in this investment. What most people do is they take the 100
Mhm.
and they would move it to the 20. They'd feel good because, man, I'm getting 20. I wasn't getting 5.
Mhm.
But what if the 20 went to 0? What have you got?
Nothing.
Absolutely nothing. The 100,000 not earning anything up here because it's not there, and now it's no longer not here.
Yes.
If I leveraged my life insurance with the $100,000
Yes.
and I made the same investment and the same investment went to 0, what do I have?
Still have that life insurance contract.
I have the contract, which can recover the loss of the 100,000
Correct.
through dividends, even if I don't have to pay any more premiums, through the death benefit, and it's forgiven.
Mm-hmm.
The loan is forgiven at death because they reduce the death benefit to the beneficiaries.
Mm-hmm.
So they're not going to lose. That's just the worst case scenario. Best case scenario, I put 100,000. You're going to need your calculator.
Yeah. I
put 100,000 to get a 20% return in 1 year. That's 20% of 100,000 is $20,000, right?
Yes.
So it cost me $100,000 to get a $20,000 return. If I borrow 100,000 to get the same 20%, what does it cost me?
Let's say 5%. So it cost me $5,000.
So it costs you 5,000 to get 20,000. Yes. What's that rate of return in 1 year? I hadn't done it, but I'm going to say it's around 400%.
Let's see. Am I doing the math wrong? So you do
5,000 to get 20,000. There's 20,000 divided by 5,000.
You need to do that. Can you do that on a calculator?
Mm-hmm.
So you do
20,000 divided by 5,000.
20,000 divided by 5,000. Yeah, that's 400%.
400%.
Yeah.
Because of the use of leverage. Now, where's the 100,000? You still have the 100,000 in the policy, earning interest and dividend.
So you're saying if someone's the whole thesis around buy term invest difference is you can get a better rate of return, and you're saying if that's the thesis you're going down, you can still get a better result and be better protected all going through life insurance. Not that you're saying you personally would not put money into cash value, a very safe asset, and then leverage against it to go put it into those investments. That's not what you're saying.
Not those types of investment. I put it in one that I have some degree of control in the outcome of the
right.
Real estate, for example.
Yes.
I'm fond of real estate. So yes,
right.
I would for that.
But you're saying even if someone's having that as a talking point, using whole life insurance as a pass-through entity to be able to do that is going to give you a better outcome than just having money in that asset directly.
Yeah, and everything doesn't have to go right.
Yes.
Even if one thing goes wrong, you still get the result.
Trent, we're coming up on time. We did not talk about person A versus person B when it comes to distribution. We'll just have to have you back on. Is there anything else that we've not talked about that you think would close some loops, land the plane as we wrap up?
Yeah, I'd say two things. Number one, chasing a rate of return is not the way to win.
Yeah.
Chasing a rate of return is for only one piece of the whole puzzle. First of all, you got to know that you have a picture for your puzzle, right? Most people are operating from financial statements. They have no idea what the future picture looks like. What I love about the model, this is the only system that has a model, is you can know the picture in advance. You can test it in advance. You can test the ups, the downs, and the movements of money in advance. And you can save within the software each scenario that you could build out through your lifetime. What we have to build into financial lives are flexibility, control, liquidity, access, and then the protection. And protection has to come first. We just finished the World Series. Phenomenal series between the Blue Jays and the Dodgers.
Great game. Game 7. I mean, all the games were great, but Game 7 was unreal.
Toronto lost by 2 inches on the play-to-play. Now, that was the play that got highlighted, but they lost. Both teams had several chances to win. Phenomenal. I'm a baseball fan. But here's the deal. The defense is what set up the offense to win. You cannot get a high enough rate of return to overcome a bad defense. So you must come in, and the reason I do this, and a lot of teams I coach do this, is they say, we're going to protection first because we care about the client. And we're not going to use math alone to get to the result. If the concept is true, and is always true under all the different scenarios that you could put in it, then the numbers will be whatever they will be. But you have to be in control of the decisions and the ability to make. You'll have, and you mentioned Garrett, and you're your best asset, and things that we've talked about for years is you protect your best asset, which is you. That's your imagination, your ability to learn more, your ability to produce, your ability to make good decisions or to overcome bad ones, which we've all had to do. Then you invest in things that you have, that you're passionate about, that you understand, and that provide value for others. And then you try to give away more than you've accumulated and see how good that works, because you can't do it. You will always get back more. And it may not always be in the riches of stuff. What I sell, if I sell anything, is for people to be in position to create greater memories, experiences, and legacy with certainty. That's what I try to teach advisors. I do coach advisors. I'd love to talk to people that would be interested in that. I got a limited number of spots for one-on-one coaching for next year. I only have about 8 spots left for next year. But I do have a group program. We got 2 group programs that are doing exceptionally well right now. There's no limit to them.
How can people find out more about that?
You can go to my website, which is just my name, Trent Fortner, TrentFortner.com.
Okay, that'll be in the description.
There's lots of testimonials of people who I've coached. I think we got 12, one for every month this year, that are telling stories for this year. And there's some from the past. And a lot of them are very well known.
Yes.
And I'm just honored to be a part. I'm honored that you invited me here to be able to share.
Well, thank you. Thank you for this. I hope you guys enjoyed, and very, very much look forward to hearing your guys' feedback.
Thank you.